All right, good morning. Welcome to the August monthly market update, and thank you for joining me. Or if you're watching this after the fact, I hope you enjoy it. This webinar continues our monthly series to discuss what's happening in the global and domestic economies and the markets, and to provide you with an opportunity to ask any questions that you might have or to discuss what you or I were seeing out there in the real world and how it might impact your personal finances and your investments. So in the email invitation, you should have received the market update quick hits summary that summarizes the key points about what's happening or what happened for the month. You are also welcome to watch the video blog post by Chris Fasciano, who is Commonwealth's Chief Market Strategist. Chris has a lot of great information, and he's a wealth of knowledge regarding the markets and investments. So I encourage you to watch his video in addition to this as well. So we're going to go through the quick hits real quick in the slides here. I'll talk about some of the things that are impacting the markets and overall performance. And then if you'd like, you can ask any questions that you might have, or you're also welcome to send those questions to me directly by email, or give me a call and schedule some time to discuss what we've covered today. Okay. So let me just jump right into it. So here is the quick hits, at least the summary from that document. I will also note that in that document, there's a lot more information. You're welcome to review these monthly documents on our website. If you go to www.leslieroperday.com and click on market updates, you'll be able to find the documents and the videos as well. And it has a wealth of information that I'm trying to summarize here. Okay, so quick hits here. So the lack of progress in the negotiations to end the war in the Middle East and a return to military action led to a 21% rise in oil prices in a mixed month for stocks. So much of the weakness was concentrated in several high-flying artificial intelligence beneficiaries focused on semiconductors and memory. However, underlying trends in the market remain positive. So that's kind of the summary. I'll go through the details here in a second. Some factors beyond the headlines. We mentioned volatility masks the improving underlying trends. Clearly, it was a volatile month in the fixed income markets. We're clearly aware of the geopolitical dynamics happening abroad. So looking ahead, risks exist, but the fundamentals should provide support for the markets. So let's jump into that. We'll kind of look at what happened in the month of July in the markets. So as you can see, this is the market performance for the month of July. My eyes are not as good as they used to be, so I need to make this a little bit bigger for myself. Okay, so after a bit of a pullback at the end of June and in July, we saw some return to positive performance, particularly in the NASDAQ, that ended for the month of July up about 4.5%. Okay. The S&P 500 was a little bit more subdued. It came in at about a little over 2.2%, 2.3%, or 2.28% to be exact. And the Dow Jones Industrial Average ended slightly lower, relatively flat at negative 0.82%. Also, the international markets index, the MSCI, ACWE, XUSA, came in slightly negative as well. So international markets have definitely been the high flyers for the year so far to date, but kind of ended up relatively flat to slightly negative for the month of July. And then also the Bloomberg U.S. Aggregate Index, that's the bond index, that ended slightly lower on some higher overall interest rates, particularly on the long side of the curve. So generally speaking, just basically a mixed month for the markets. If we zoom out a little bit and look at our overall year-to-date performance, a little bit of a better showing here. As you can see, the through this is year-to-date, beginning of January through the end of July. The Dow Jones was up 3.7%, the S&P up 7.78%, and the Nasdaq up 9.38%. So as you can see, we started the year off well. We had a sizable drop earlier this year in the month of April, largely spurred by the conflict in the Middle East. Then we've seen some recovery gradually over time over the last few months with some positive results. The green line there is the international index, so up 18% year to date. Again, so even though we have seen a recent pullback, largely international still seems to be the outperformer for so far this year. Really on all of these indexes seem to be doing well for the year, but that's been a particularly positive one. So
on our presentation, it's still on the main page.
It's
on the screen.
I'm sorry, hang on just a second. It's still
So sorry.
it's
on,
still
on the presentation view, what
Yep.
we're looking at, we're still seeing your header page. We're not, it's like not progressing.
Oh, it's not progressing.
Yeah, it's still on this page.
Interesting.
What we're seeing.
Okay, so tell me if you can see that now. So is it still showing the header page?
Yeah.
Okay, well, let me try it. Let me stop sharing. I'm going to try to share a different way. Nope, thank you for letting me know.
Okay, looks like you're doing something.
All right. There we go. Hang on. Get there in a second. There we go.
Yeah, I have that. That's what's showing up.
Is it still showing?
Mine looks exactly like yours. It has the same thing.
Let's see here. Sorry, everybody. This is an unusual circumstance. So
There you go.
how's that?
Perfect.
Is that better?
Yep.
Okay. Technical problems. Okay, so let me go back for a second if you didn't see the previous slide. Okay. So here is the July performance. Like I said, the S&P, I'm sorry, the Nasdaq ended up 4.5%, the S&P up 2.28%, and the Dow Jones down slightly 0.82% for the month. All right, so going forward, again, this is year to date. So as I mentioned, we had a slight dip in the middle of the year when the conflict in the Middle East started. But generally speaking, we've continued an upward trend so far for the years. Okay. All right. And then just kind of to zoom out a little bit further, here is the previous 24 months. So what I'm showing here is all of these indexes just zoomed out for a 2-year period. And what you're seeing is there is the down lines, the red lines indicating kind of a downward slope versus the green lines indicating an upward slope. And so what you're seeing here is over the past 24 months, we've had 3 sizable downturns followed by 4, or actually I guess 3 sizable upticks. So for the past 24 months, the Dow Jones is up 17%, The S&P 500 is up 32, almost 33%, and the Nasdaq's up a whopping 40, almost 41%, with international up 25%, and bonds even still up about 5%. So even though we have the risk of some potential downturns, you also need to keep those into context and realize that with the downturns, usually there is a return back to the positive side at some point. Okay, now let me pause that for a second while I readjust my presentation here, given the fact that my my technical skills obviously have been tested today. Okay, so let me just kind of talk about, so that's the performance that we have seen so far. Let me back up for a minute. Let me talk about what's kind of going on here. So as I mentioned, July was a mixed month, right, for some of these numbers, but largely we're still positive for the year. A big change for last month was bonds were down, as I mentioned, on rising interest rates. The 30-year Treasury yield is now up to 5.2%, and that's the highest that the 30-year Treasury has been since 2007, so almost nearly 20 years here. And it certainly reflects a steepening of the yield curve. And what I mean by a steepening of the yield curve is when the longer dated bonds, such as the 30-year Treasuries, are increasing relative to the shorter dated bonds, the 5 and 10-year dated bonds. So the yield, the amount of interest that you can get on those, is increasing. That has the effect of pushing bond prices down. So there's been a little bit of a concern in terms of the returns for bonds. I'm not overly concerned about it. I think it's somewhat driven by what's happening in the energy markets and the fluctuations of interest rates and the uncertainty around what's going to happen with the Fed. But I don't think that it's anything outside of the norm right now. It is also not uncommon for midsummer markets to be mixed, which is what we were seeing this summer. Some of those mixed returns are a result of some of these conflating factors, the international effects, the interest rate risk, as well as overall economic output. But despite some of these things, the U.S., as well as the world economy, does seem to be carrying on decently, even with those higher energy prices that we're seeing. And because a lot of that is being driven by this conflict in the Middle East. If we look at the U.S. Gross domestic product, the U.S. Q1 GDP, so Q2 GDP slowed for the month of July relative to the first quarter of the year, the Q1. So we had a reported Q2 GDP at 1.5%, down from about 2.1%. So it does show that the economy is slowing slightly. That's probably being driven by the higher energy prices that we're seeing. But we are still positive. The economy is still growing, and so that indicates that the U.S. economy seems to be largely resilient relative to what's happening with energy. Additionally, we did see a slight loss of about 23,000 new non-farm jobs created during the month of July, and that is it is a concerning trend, given that we're seeing a gradual slowdown in job creation, but it's also coming off of some unusually high job creation numbers during the first half of this year. So it's not surprising that companies may be taking a little bit of a breather, especially since they're dealing with some of those higher input costs. They're making some of those trade-off decisions between hiring workers or just kind of taking a breather. So that's also not surprising. One of the most significant factors driving the markets. See, hang on, make sure that I've still got everybody participating in the meeting here. Okay, looks like we're good. One of the oh, one of the most significant factors driving the market growth this year has been the pretty phenomenal earnings that we've been seeing companies report. Second quarter earnings on the S&P 500 came in with an average of 29% earnings growth for the second quarter, and that's above the 22% estimates that were previously put out. So companies are reporting even higher earnings than the high estimates that were previously indicated. So even though we're seeing these higher costs, American companies and to a certain extent international companies seem to be weathering the inflation storm that we are currently in. And as of now, right now, it appears that those earnings estimates are expected to continue to grow, with full year earnings estimates being increased as well. So that is suggestive that we will continue to see some market appreciation happening through the rest of this year. And additionally, there was been some concern that these earnings are narrowly focused in all of the AI company stocks, and those companies have definitely seen higher levels of market appreciation and earnings, but a lot of the earnings that we're seeing are continuing to be broadly based. So that means that the S&P 500 equal weighted index has been outperforming the cap weighted index. So that is suggested that despite the size of the business in the index, right, even though smaller companies are still continuing to report outsized returns. So that is suggested that these earnings growth are broad based, and that is floating all of the boats in the indexes. So that's a positive factor. Now we talked about energy. We talked about inflation. Inflation's a big one that is on everybody's mind. Last month's inflation report came in at 3.5%, which is significantly higher than the Fed's 2% target, and potentially suggestive of interest rate hikes. And I know that there was some signaling around interest rates hikes. I think that I'm not as optimistic that we will see an interest rate hike unless we continue to see much higher levels of inflation. I think they're taking a bit of a wait and see, because if you look at the breakdown in the inflation reports, the largest driver of the higher inflation rates right now obviously is energy prices. And so if we do see energy price appreciation normalize, that should also suggest that inflation will also come down as well. So this month's inflation report came in a little bit better at 3.3% versus the last one at 3.5%. So a little bit less. Part of that probably is being driven by the fact that energy prices came down in the month of June, when the so-called ceasefire happened. That was short-lived. So now that we're back at it, energy prices are back up. So maybe that will have a negative effect on the inflation rate. This is just a wait and see situation. The Fed's target is still 2%. We have obviously a long way to go for that. But as long as the U.S. economy and companies seem to be weathering this inflation storm for the time being, I'm not sure whether or not we're going to see any rate hikes. Further, I don't know that how rate hikes are really going to dampen inflation when it's primarily being driven by higher energy prices. So anyway, we'll see. It's a wait and see. Besides what's happening internationally, the one other thing that is coming at us quickly is the midterm elections. Election cycles do always have a tendency to create additional uncertainty and market volatility. So although things generally look positive right now through the rest of the year, outside of inflation, and costs. From a macro standpoint, we still could be in for some market turbulence over the next few months, at least until the election is over. So buckle up. I'm sure you're all getting hit with ads and as we run into this um, election cycle. So, all right. So to wrap things up, overall, we seem to be in an okay spot. The economy is doing okay, although we're all feeling it with higher prices. And for now, the markets seem to be continuing to push forward. Workers are still being hired, consumers are still spending, home building is still continuing at a modest pace, earnings are still growing, and all of those things are pointing towards continued growth in the markets. I don't anticipate we're going to see the same types of market appreciation that we have for the last 6 to 12 months. I could believe that we might see some flattening out of the markets, but it still looks like we're going to be heading towards a growth trajectory, at least for the time being. Okay, so that wraps it up for the time being. Are there any questions that I can answer that anybody might have? You are welcome to unmute yourself if you'd like, and we can do that. If there are no questions, again, you're welcome to reach out to me after the fact to talk about any of the things that we discussed today, or any others for that matter. All right, our next session's coming up. So the next learning topic, a webinar, is going to be on Wednesday, August 29th, in a couple weeks. That is going to be on cybersecurity, titled "Don't Let Them In: Protecting Yourself from Scams and Cyber Threats," something that I think that we are all potentially at risk of in some form or another. So I'm going to be covering various types of scams and cyber threats that we may be seeing out there. So if that's of interest to you or any of your friends or family that may be potential targets, feel free to join me on that or invite them to join during this session. There'll be a lot of good information. There will be no webinars in September. My wife, Dean, and I are celebrating our 25th wedding anniversary and taking a trip to Europe. So we'll be gone during most of the month. So we're not going to have any webinars in September. I will pick it up again in the month of October on Wednesday, October 14th for the next monthly market update. So I will try to cover all the stuff that happens in the month of August and September during that monthly market update. Okay, so that is it. Here's our contact information. I appreciate everybody joining me today for this monthly market update. Enjoy the rest of your summer, although it's coming to an end quickly, and enjoy the fall that's coming. The fall weather will be here before we know it. Okay, thank you very much. Take care, everybody.